Welcome back to the show, and we are welcoming, of course, our good friend Tucker Maxwell. Tucker's got 6 years of mortgage experience and is a top 1% originator nationally, specializing in loans for real estate and real estate investors. Today is a wild card for Tucker. He doesn't even know the questions that we're going to be asking him. These are just common questions that most of our clients ask us throughout the process, and they're not going to be in any sequential order. So, welcome back to the show. Ooh, I guess I should put you on. Boop, there he is.
Thanks.
And as always, let's begin our segment. How was your weekend? Did you do anything fun?
I did. Went to the Sounders game. Disappointing result, but it's good to see the Sounders back in action at home.
Yeah, so they were playing in a regional competition. Is that right?
Yeah, they were in the Leagues Cup.
The Leagues Cup. It's funny because I was talking to somebody else about it, and I don't follow the Sounders as closely as I used to, but this was like the Leagues Cup. It wasn't CONCACAF, which that's a whole nother one, right? So who's in the Leagues Cup?
Yeah, so it's basically the top teams out of the Mexican Professional League and the top teams from the MLS.
That's why it was mixed, because I thought it was like, oh, it was just one team from each. Okay, so how many teams total are in that?
I want to say it was 8 and 8, 8 MLS sides and 8 Mexican Liga MX teams, and Miami from the MLS ended up winning the tournament.
Winning the whole thing. So it was a weekend tournament?
It was about a month.
Oh, month-long tournament. And this was the last bit of it. Okay.
All right. And then the Sounders were back in action this weekend in their regular MLS schedule.
Gotcha. And so you guys didn't know that you were watching a soccer report podcast.
Hey, Ted Lasso's popular. People will love it.
Right. Ted Lasso. Well, I play golf, and I feel like I'm improving my game every time I get out there. I shot a 93 on Saturday. So for me, that, I've been playing with 100, and then I played again on Sunday, and it felt even better. So I feel like I'm starting to be able to enjoy it a little bit more.
Nice.
That's my weekend. All right. Well, let's jump into these questions, Tucker. So, every day these questions come up. So I thought it would be great to have a podcast on record where these common questions could be addressed right off the gate, even though we talk about them in different ways. So let's start with this first one: is what is the interest rate and how is it determined? If I am a individual looking to get a loan, what's the interest rate? How's it determined?
Yep. So the interest rate is the finance charge for the amount of money you're borrowing. So if a bank is going to give you money to buy a house, there's going to be some charge with borrowing that money. And so the interest is the percentage or the fee associated with borrowing the money. And how it's determined is it's a reflection of the risk that you present as a buyer to the banks. The higher the risk, the more we're going to charge, because there's a higher chance of default, which means we need to protect ourselves a little bit more and charge appropriately for that risk. If you're a great credit profile, high credit score, big down payment, that's perceived as less risk to the bank, and therefore we can charge you a lower interest rate.
And the calculation of that risk is more than just one factor. Credit score is one of them, but there are I want to say somewhere around 30-ish more.
Exactly. Yeah. Down payment percentage, debt to income ratio, number of borrowers on the transaction is a big one, like one borrower versus two. If one person loses their job, we have another borrower that's still employed that can help make the payment. The type of property they're buying, condo versus a single family home versus a manufactured home. There, like you said, there's 30 or so variables that play into us evaluating the full risk and likely for default.
Yeah. And I think that's important to put on the record because, how many times you say, well, call this lender, they got my brother this rate. Well, the lender has something to do with it, but it is all a very individual process or combination of applicants process. So it's not as simple as this lender versus that lender. It's definitely a little more complicated. All right.
Yep.
Great. Next question. What closing costs will I have to pay?
Yeah, so closing costs is a term that we use for all of the fees associated with buying a home. So these are one-time fees and or some like prepaid items such as taxes and insurance that you pay at the time the home loan closes to complete the transaction. So this is above and beyond your down payment and covers things such as the appraisal fee or the settlement fee that's paid to the title and escrow team closing the transaction, or all of these line item folks that are involved with the transaction have to be paid. And so your closing costs are the total of all of those fees that are accumulated during the transaction to buy the home.
Yeah. So specifically for buying the home, if you're gonna inspect the property, you're gonna pay for an inspection. You're also gonna pay for an appraisal. Okay. It
Yep.
doesn't matter who you work with, you're going to need those two things. You may waive inspection, so you might save some money there, but you're also going to have an escrow company close the transaction. So you pay your half of the escrow fees. And then if you're borrowing money, right, you're actually going to buy a title insurance policy for the benefit of the lender.
Yep.
Meanwhile, the seller buys a title insurance policy for the benefit of you. So there's two title insurance policies when there is a lender involved. And
Yep.
then the rest, recording fees, wire transfer fees, and then there's probably some lending fees depending on the structure of the loan, right?
Exactly. Yeah. So processing and underwriting fees are two really common ones. The the lender will also charge the wire fee, like you mentioned, to wire your loan amount to escrow. You also have recording fees that are based on the number of pages in your loan documents. There are miscellaneous charges as well. Another one would be flood charges. We're going to charge $9 to determine if a home is in a flood zone or not. It's required on all transactions that have a home loan. So little things like that. And each item that's being paid out is spelled out to the penny as to what goes into those closing costs so that there's full transparency and we can't
Yeah, and
just
I was going to
fluff it up.
say it used to be in the past that somebody say you've got no fees, and they would wrap it in the rate of the loan.
Yep.
They still have to get itemized. So be wary of somebody that says no fees. Generally speaking, they're making up the cost to pay for those items in the rate, so that can affect the rate.
Exactly. That's a really good point right now with the idea of, marry the home and date the rate and refinance down the road. A lot of lenders are out there advertising no fee refinance. That's not accurate. There are always fees associated with a transaction and re-recording a new note. And so we have to be really careful about what that actually means and where those fees are hidden, because somebody's that's handling that transaction has to be paid for their service.
Yeah, those things have to get paid. Yeah, and
Yep.
whether you go in with a low or no or minimal cost, having a partner that works with you on your mortgages so that you ensure that you're getting the best possible deal. That's where the people that like, and trust matter, rather than just picking a price and saying that's the lender I'm going to work with.
Exactly.
Okay, these are good. Next question: how much of a down payment do I need?
So that's a great question. In Washington, specifically on the East Side, we have Washington State Housing Down Payment Assistance Program and FHA programs that can help buyers with literally zero out of pocket. So we can do 100% financing, but typically, to answer your question, I think 3% is kind of the right answer there. That 3% is usually the entry point for buying a home.
Yeah, 3%. And then that actually ties into my next question is, what is PMI? How can I get rid of PMI, private mortgage insurance, if it is required if you put less than 20% down?
Yep. So private mortgage insurance allows us as lenders to add an additional layer of risk mitigation when a borrower has less than 20% down. Because again, it's a default conversation. We're trying to evaluate what is the likelihood that this person buy the home, defaults on the loan, and walks away. We don't want to be left with a home that we can't sell for the amount that we lended to them if the market shifts. So private mortgage insurance is involved when a buyer buys a home with less than 20% down, whether it's 19.5% or 3%, it doesn't matter. Less than 20% requires mortgage insurance, and it's typically collected in a monthly amount that's part of their payment until they reach 20% equity, at which point, in most situations, it will drop off.
Okay, all right. So private mortgage insurance. Should I lock my interest rate, and when?
That's the $1 million question. So right now, we're in an environment where rates are moving up. So what we're telling most people is we want to lock as soon as we can. So if you go under contract today, that's at which point we can lock in an interest rate, and we should be evaluating interest rates as quickly as we can to hedge against the likelihood that rates tomorrow might be worse than today. So in most industry experts are saying lock on contract right away. we also need to be mindful of the buyer's circumstances. If they are at 49.9% debt to income ratio and they cannot possibly absorb a higher payment amount in there to qualify, we have no chance to kind of float it or gamble the rate. We need to lock at whatever is required to be able to close the loan. If let's say we're Dan Edwards and we have a 10% debt to income ratio, and I'm saying, Dan, there's a 50% chance rates go up tomorrow. There's a 50% chance they go down. We're not going to have any risk of not closing your transaction tomorrow. What do you want to do? Are you a gambling man? Do you want to take a chance on that 50% going down and then we won by floating? Or are you okay with, if we take that risk and rates go up, we're still okay? So it really depends on the buyer and what's their comfort level with waiting it out. Right now, we don't know when rates are going to come down. As of lately, they've gone up. And so we're assuming they're going to continue to go up until inflation data looks better. And so with that in mind, we're locking on contract as quickly as we can.
Yeah, and let me be clear about this. Those people that are out there getting a pre-approved right now, is your home search may take several months. Yep. If you get yourself in a situation where you're pre-qualified, we've talked about pre-qualified versus pre-approved, and interest rates have moved, and you don't have somebody watching that file for you, you may be priced out of that house that you're bidding on. We had a situation where somebody had been searching for a few months. They got the offer accepted, went back to the lender to get their application started, and it turned out they couldn't afford that home anymore because rates had gone significantly. And this was when things were moving earlier this year. So it's super important that you stay in good communication with your lender, so that if something significantly changes, they can alert your real estate agent so that you can adjust your price if you need to, or modify how you're writing an offer. So that's just really important in this environment. All right, let's see. I've got 2 more questions. How much home can I afford?
Yeah, that's a great question. It's going to be specific to the applicant and what their income and their assets tell us. So in most loans, we can use up to 50% of your income on your bills. That includes all your existing credit cards, car payments, student loan payments, and the additional mortgage payment that we're applying for. We can't exceed, in most loan cases, 50% of your income. And so that's really what's going to determine the ceiling. It's going to say, okay, Dan, based on your application, the maximum you can borrow based on today's interest rate is X. And that's what sets that ceiling. And that's really the purpose of a pre-approval, is it allows us to dial in the factors, income, liabilities, and calculate that debt to income ratio to know what the ceiling ultimately is, and then say you can shop below that. If we go above it, we need to either increase down payment, we need to buy down the interest rate, we need to ask for seller credits to help us with that, whatever the scenario may be. But it just gives us, okay, here's kind of the ceiling, and then is that beyond what you're trying to buy, or is that less than what you're trying to buy? And how do we get you in the actual home that you want to buy?
Yeah, I think it's important to give yourself a range anywhere from 30% to 50%, depending on where you are income bracket wise. Yep. Like obviously, if you're making $5,000 a month, $2,500 a month payment wouldn't be super wise, right? Yep. Okay, so you have to kind of think from that standpoint. So, a lot of people are able to qualify for rent, that may be a higher percentage than you normally would be able to qualify for a mortgage. You have to play around with that number a little bit. But so I would give yourself a sliding scale, 30 to 50% of your monthly income going to housing costs is probably, it depends, right? Because if let's say you make $50,000, well, what's the big deal? You're not gonna take a $25,000 a month mortgage, right? That'd be silly. So, anyways,
yeah, I get that question a lot. Is people want me to tell them like what is the appropriate amount or percentage that we should use, and really it depends on their lifestyle, their expenses. And I always tell people, especially for first-time home buyers, is evaluate your monthly rent. Are you being stretched at that amount, or are you able to easily save? What are you feeling now? And use that as a gauge to what you can take on for a mortgage payment. I can't tell you 30% or 40% or 50% is going to be the right answer for you until I know your entire lifestyle.
Yeah. And like I've said before, like if you're saving up to buy a house, okay, take 30%, take 40%, see how it feels. One of the cool things about a house is it's a forced savings plan.
Yep.
So while, yes, you are paying interest, especially a lot of interest in the first 10 years of that mortgage note, you are building principal in there, equity in there as
Yep.
well. So it's kind of like a forced savings plan. And most people don't save as much as they do when they own a home.
Right.
Meaning, you're like, okay, we're going to 2000 is our rent payment. And then we're going to blow the rest because we're going to Tahiti or we're doing something like
Yeah.
that. So when you have a home, you're like, oh, hey, we've got to fix the skylight or we've got to do that. So you're starting to kind of look at things a little differently. But yeah, I agree. It's a good range. It's a good rule of thumb to quickly kind of identify whether or not you can afford the market. All right,
Yep.
last question. This one is more open-ended. So it's what loan programs are available for my situation. I could probably answer this in saying that there are a lot of different ones and it really depends. Am I right?
Exactly. Yeah. That's really the complexity of this whole thing is there's tons of different loan programs. And I think a bigger question is, should we buy down the rate? Should we not buy down the rate?
Yeah.
Even getting into the specifics within one loan type, there are a lot of variables. So it's just important to going back to your comment about working with somebody like, and trust that is willing to go through the work to say, okay, Dan, here's 5 loan options for you. And here's the pros and cons of all 5. Let's say you make the decision. Is monthly payment most important, or is money out of pocket most important, or is the least amount of interest paid most important? What is most important to you as a buyer? And then let's back into the right loan type. But the lender, our job is to really just educate you on all of the options that potentially would fit your scenario, and then let you pick based on what outcome you're trying to achieve.
Absolutely. I think you said it great there. Well, hey, a big thanks to you, Tucker. Thanks for sharing your thoughts on this. You can reach out to Tucker, 425-757-9202. If you heard it from us here, please let them know that's where you heard.
Yeah.
All right. So that looks like we are at the end of the show. We've got some stuff coming up. It looks like this Saturday, August 26th, this is in the International District. So the great thing about living on the East Side is you can quickly get into some awesome world-class stuff going on. So it looks like there's a block party. So live music, beer garden, import car show. So that should be awesome. If you know of somebody that would love to feature their business on the East Side with us on this podcast, please reach out to us. You can do so by calling 425-200-4093. Reach out to me, Dan Edwards, managing broker of the East Side Real Estate Team. We hope you enjoyed this episode. Please share, like, and subscribe again. Thanks again, Tucker, for joining us. And that concludes our show. Thank you.
Nice.